China's economy, once seen as unstoppable, is now facing serious trouble. Imagine a country that built enough homes to accommodate 3 billion people, 3 times its population, yet finds itself struggling to keep its economy afloat. This is the reality China faces today. With a youth unemployment rate so high that the government stopped reporting it and massive real estate projects lying unfinished, the cracks in China's economic foundation are impossible to ignore. Did you know that the real estate sector alone makes up nearly 30% of China's GDP, but entire cities remain empty? Their debt has skyrocketed to levels that could soon surpass even the most indebted nations, reaching a staggering $50 trillion in real estate alone. How did a country that lifted 800 million people out of poverty and became the world's second-largest economy fall into such disarray? The answers lie in a mix of overdependence on debt, poor planning, and strict government control. Why did this happen, and what are the global implications? Discover the startling truths behind China's economic turmoil and the potential shockwaves it could send around the world. China's economic growth has relied heavily on the real estate market. For decades, the government encouraged property development to drive growth. This resulted in massive construction projects, with new homes and buildings springing up everywhere. However, the market soon became oversaturated. Imagine building enough homes for 3 billion people, 3 times China's population. As a result, many of these homes remain empty, creating ghost cities. Moreover, the real estate sector contributes almost 30% of China's GDP. When people couldn't buy homes because they were too expensive, developers borrowed more money to keep building. This led to a debt spiral. China's real estate debt has reached a staggering $50 trillion, threatening to destabilize the entire economy, source BBC. When the government imposed strict regulations to control this, it only worsened the situation, leaving many projects unfinished and developers bankrupt. The government's attempts to cool down the property market by introducing measures like the 3 red lines policy further exacerbated the problem. These regulations limited the amount of new debt developers could take on, but instead of stabilizing the market, they pushed many companies into financial distress. This shows how intricate and interwoven the economic structures are, where a solution in one area can cause ripples of disruption in another. One of the most pressing issues facing China is its high youth unemployment rate. Many young people in China are struggling to find jobs despite having higher education degrees. The problem is so severe that the government stopped reporting unemployment figures to avoid public panic. The youth unemployment rate rose to 21%, the highest since the survey began, source Reuters. With fewer job opportunities, young people are discouraged, which impacts their ability to support the economy through spending. The lack of job opportunities is partly due to the rapid changes in China's industrial landscape. Many manufacturing jobs have moved to countries like Vietnam and Mexico, where labor is cheaper. This shift has left a gap in the job market that China has not yet filled. Additionally, the push towards a more technologically advanced economy has not kept pace with the education and training systems, leaving a mismatch between the skills young people have and the jobs available. China's growth has been fueled by borrowing. The country has relied heavily on debt to finance its infrastructure projects and maintain high GDP growth rates. Local governments have also borrowed extensively, using loans to fund various development projects. However, this debt-fueled growth is unsustainable. As debt levels rise, so do the risks of defaults and economic instability.
China says that the country will prioritize stability and employment over aggressive growth this year, even as it seeks a full recovery from the pandemic.
The total debt in China, including both public and private sectors, has reached over 280% of GDP, source Financial Times. This massive debt burden poses a significant risk to the economy. The government's top-down control further exacerbates the problem. Instead of allowing market forces to guide the economy, the government tightly controls economic policies, often leading to inefficient and wasteful investments. For instance, many infrastructure projects funded by these loans do not generate enough revenue to pay back the debt, leading to a vicious cycle of borrowing and spending without sustainable returns. China was once known as the world's factory, producing goods for countries around the globe. However, its manufacturing sector has been declining. In 2010, manufacturing contributed about 31% to China's GDP, but this has fallen to around 27%. The decline is due to several factors, including rising labor costs and increased competition from other countries. Countries like Vietnam and Mexico have become more attractive for manufacturing due to their lower labor costs and favorable trade policies, sourced The Economist. As manufacturing jobs move away from China, the country struggles to find new sources of economic growth. This shift has also led to job losses and reduced income for many Chinese workers. Furthermore, the decline in manufacturing affects other sectors of the economy, such as transportation and logistics, which rely heavily on the production of goods. China's demographic changes also play a crucial role in its economic troubles. The country is facing an aging population, with fewer young people entering the workforce. By 2050, it is estimated that 30% of China's population will be over 65 years old. This demographic shift places a significant burden on the economy, as there will be fewer workers to support the growing number of retirees. The shrinking workforce and aging population are major challenges for China's economic future, source World Bank. With fewer young people to drive economic growth, the country must find new ways to sustain its development. The aging population also increases healthcare and pension costs, further straining the economy. Additionally, the one-child policy, which was in place for several decades, has led to a disproportionate number of elderly people compared to the working-age population. This demographic imbalance exacerbates the economic strain, as fewer workers must support more retirees. China's economic crisis is a complex and multifaceted issue. The over-reliance on real estate and debt, coupled with government control and demographic challenges, has created a precarious situation. As the country grapples with these issues, the global economy must also brace for potential ripple effects. Understanding the root causes of China's economic troubles can help us better prepare for the future and learn valuable lessons about sustainable growth. China's path forward will require significant reforms and adjustments. The government will need to balance control with allowing market forces to operate more freely. Investing in education and training to align with the needs of a modern economy is crucial. Additionally, addressing the demographic challenges through policies that support families and encourage higher birth rates could help mitigate the aging population problem. The global community will be watching closely, as China's economic stability is crucial for the world's economic health.